Are you recording that?
Yep.
Excellent, excellent. Hey, will you put it on my online class? Can you post it on YouTube and let me know where it will be or something?
Yes, ma'am.
See, I don't know how to do all of that.
Oh yeah, I just got this computer, so yeah.
That's an awesome computer.
Thank you.
Let me see. Oh, not so awesome. Not. Hey, you know, if you got it, you got it, right? Okay, let's get back to it. You can use portfolio and active losses to offset portfolio and active gains. But now, because so many people were buying into passive properties and passive shelters so that they could offset their big wages and all, the government now puts a limit on how much passive income you can use to offset your active and portfolio income. Now, the passive losses that we're going to talk about will be rental. I want to go ahead and tell you that if you have a loss in a limited partnership where you're a silent partner, if you have a loss, period, that loss cannot be used to offset any of this. Never.
Only if you're a silent partner.
Yeah, if you, from a limited partnership, okay? Listen to me carefully. Because so many people, as they're growing older, they tend to get married and buy a starter home. Then they have children and they need a bigger home. So they'll buy a bigger home in later years. And a lot of times, rather than sell their first home, they'll keep their first home and rent it out and let that income finish paying for it. So, because rental property is handled by so many taxpayers just like you and me, the government says, or the IRS rule is, listen carefully, if you are an individual taxpayer who has a piece or two of rental property, you're allowed to deduct up to $25,000 worth of passive losses you're allowed to use it to offset active and portfolio income. But there's a rule. You have to be a taxpayer who actively manages the rental property and who only has a piece or two of rental property. Okay? Now, if you have 24 pieces of rental property, are you a taxpayer with a piece or two of rental property? Mm-hmm. No. You're in the business of renting property, right? And if you're in the business of renting property, you're self-employed. And that rental income will be reported on Schedule C as a business, okay? As a self-employed business. Now, this passive loss, only if it's rental, y'all, only rental, you can use up to $25,000 to offset your active and portfolio income, but there's a limit. You have to phase this out if your adjusted gross income goes over $100,000. Okay? If your adjusted gross income without these losses is over, in other words, if your active and portfolio income is more than $100,000, you're going to phase out this $25,000. So let me kind of show you how we're going to do that. So you see, everybody gets this $25,000 of passive losses against their active and portfolio income, and this has to be passive rental only, not partnership, rental only. Unless your adjusted gross income is over $100,000. Now, if it is over $100,000, we're going to phase out 50 cents for every dollar your AGI goes over $100,000. That's just what the reading says. In your book, there's a little paragraph, little sentences, and that's what it says. But let me show you the steps. Let me put it, organize it for you. Step 1, find excess AGI over 100,000. Okay, we're going to find excess AGI over 100,000. Step 2, divide excess AGI by 2. Doesn't 50 cents go into a dollar twice? 50 cents is half of a dollar. So for every dollar our AGI goes over 100, we're going to knock off half of it. So we divide our AGI by 2. And then step 3, phase out the 25,000. Now, let me give you a problem with this. I'm going to do it in black, so. There's really going to be a step 4, but I'm going to get to it in a minute and see if you understand it. Okay, let's say that Sue and Sam have AGI of 112,000. They have rental losses of, let's see, rental losses of, let me see how much I want to do, 26,000. Okay? Rental losses of 26,000. Now, could they take the 26,000, all 26,000? Nobody can take all 26,000 because the limit for using rental losses against active and portfolio income is 25. That's the limit. So what we're going to do, we're going to start off with the 25,000 because that's the limit, and we're going to phase some off of that. Step 1, let's find our excess AGI. 112,000 minus 100,000. Excess AGI is 12,000, right? Okay. So, we're going to, step 2, take that 12,000 and divide it by 2. 6,000. Now it's this 6,000 I've got to deduct from the 25,000 allowable losses. Okay? So, 3, I'm going to take 25,000 minus 6,000 equals 19,000. So, 19,000 is the limit, the most rental loss I can take, or Sue and Sam can take, because of their AGI. Do you understand so far?
Well, I mean, can you, like, if the 26,000, if they didn't make the 100,000, if they had 26,000, could they allocate a bit of 1,000 to next year?
Yes, rental losses that cannot be used can be carried over.
Okay.
They can be carried over and brought down, but every year you're limited to the 25, you know, or whatever it's phased out to be.
Is there
now
a limit to how long you can carry it?
No.
Okay.
Okay? Our step 4 here would be to compare the allowable loss to the actual loss and take the smallest, deduct smallest. Boy, can you read that? Now, let's compare. Our allowable loss is 19,000. Our true loss is 26,000. we can deduct the smaller 19,000. Let me give you another example.
But you did just say we can carry over 7,000 for next year?
Yes.
Okay.
Okay? But keep in mind, every year you're going to be limited to the 25. Okay?
What amount do we carry over?
The 7. Because we actually had a $26,000 loss, and we could only use 19 of it, so we're going to carry 7,000 forward. Now, Matt and Mary have AGI of 120,000. They have a loss, a rental loss of 8,000. Okay, they have a rental loss of 8,000. Step 1, find the excess AGI that's over 100,000. It's easy to see. How much? 20,000. Step 2, divide 20,000 by 2. Yep, is 10,000. Now, 10,000 is what we have to deduct from our $25,000 limit. So our allowable loss is 15,000. Now, I have to compare my allowable loss to my actual loss, right? Which is smaller? I can deduct the whole $8,000 loss. So you see, even though I'm allowed, because of my AGI, I'm allowed to deduct up to 15,000. You can't deduct it if you didn't actually have that much loss. So you can only deduct the amount of loss you actually had, or the amount you're allowed, whichever is smaller. Are we good on that?
Yes.
Very, very good. Now, I want you to look at page 6 at the bottom of the page. Page 4-6. If you are an individual taxpayer who has a piece or two of rental property, you will report that rental income or loss on Schedule E. You guys have a Schedule E that you're going to prepare for me next time. Okay? Now, if you are a person who has a rental real estate business, you will prepare a Schedule C, because that is an individual, you're an individual, but you are self-employed with a rental business. Now, how do you know if it's a rental business or not? Well, there are some rules here. Look at 1 and 2 at the bottom. If more than 50% of your personal service during the tax year is performed in the rental business, then it's a business. Individual personal service, that means if you spend more than 50% of your 40 hours a week of your work time working on the rental property, and a person with 24 rental houses would. You're always repairing something, always trying to find people to rent your property. There's always one that's going to be empty or something that you're going to be working on. So if you spend 50% of your work hours during the year at working on the rental property, then it's a business. It's not a passive activity. Then if you spend 750 hours, if you don't really know if it's 50% of your time or not, then add up your hours. If you spend more than 750 hours working in that rental trade, then it's a business. It's definitely a business.
If you put like your own money into it, is that considered a loss? Like a
You will have your own money into it.
Mhm.
That's why it's your rental property.
Well, I mean, like, you know how you get the money from your tenants, but you like if you have like it's just one sitting there, and you have to pay for
Yeah,
that.
that's your expenses.
Okay.
That's what helps you show a loss. All those expenses that you pay out of your pocket.
Mhm.
Okay. So, are we good with that? Now, listen, if you have passive losses that come from limited partnerships or royalties or S corporations or trusts or anything like that, then those losses, you can't use them on active and portfolio income, period. You can only use those to offset other passive income. If you have passive losses other than rental, you can only use those to offset passive income. So maybe you have a rental property that you have a gain from, and you have a limited partnership that you have a loss from. That loss can offset gain of the rental property. Okay. Let's move on. Look on page 9. We're going to talk about self-employed health insurance deductions. Now listen, if you have to buy health insurance on your own because you're self-employed, you don't work somewhere to buy it through some group policy, then you're going to pay a lot more for your health insurance. Now because of this, you're going to get to deduct the health insurance on as a deduction for adjusted gross income. That would be seen on
100% of it?
yes, 100% of it. It's on line 29 of the 1040. It's just part of the adjustments for adjusted gross income on the front of the 1040. And that line says self-employed health insurance deduction. 100% is deductible. Questions?
I have a question for you.
Okay.
If rental income, if it is a business, you just have to fill out Schedule E and a Schedule C?
No, just Schedule C.
Just Schedule C?
Just Schedule
Okay.
C. Okay? Okay. I want you to read the special rules. I'm not going to take the time to go over them in class, but if you buy insurance, it is deductible if you pay the premiums for yourself, your spouse, and all of your dependents, your dependent children. And y'all, it used to be that children under 24 could be on your insurance, but now they've changed it, and children 27 and below can be on your, well actually it's up to 27. So 26 and down can be on your personal insurance. So if you're that age, you can be on your parents' insurance. Okay? And if you pay premiums for long-term care for yourself, your spouse, and your children, or if you have a dependent parent that you pay that for, then that's deductible too. But only if you're self-employed. Not if that's an expense you pay through your work. Okay? If you're self-employed and you have to buy your own health insurance, it's very expensive. I know I have a first cousin. My husband has a first cousin. He's a farrier. And he shoes the professional polo horses for Budweiser and Goodman Air Conditioning and lots of other famous teams. The teams from Argentina, they come here to play polo. And he takes care of their horses. They'll pay him $500 just to come to a game and sit there just in case one of their horses throws a shoe. So he and his wife have to buy self-employed health insurance. And I know about 10 years ago, his policy cost $1,500 a month. So today, I'm sure it's probably doubled, at least doubled. Okay. Let's turn over to health savings accounts. Yeah, Rose, y'all pay like kind of like self-employed health insurance, don't you? And I mean, it's just really expensive, isn't it? Very, very. So, you know, that's just one of us that can vouch for the fact that, I mean, and I think hers, she and I have talked about it, I think it's like over $2,000 a month or something.
Goodness.
Yeah, y'all, it's awful. And I don't know the exact amount, I wouldn't ask her. Okay, let's talk about health savings accounts. Health savings accounts are fairly new. They've come up in the last, well, they've been very prominent in the last 10 years or so. And there are so many different ways that they can be structured so that you have to read your fine lines very, very carefully, or you could end up losing some of your money. But a health savings account is nothing more than having money deducted from your gross pay to put in an account where you're going to pay for nothing but health reasons, for health reasons, and for medical reasons. You can, if you're a diabetic and you know that you know for a fact that your medicine is so much each month, then you can put a certain amount into these health savings accounts, and guess what? You put them in the account before your gross pay is taxed. So the money that goes into the health savings accounts is not taxed. It's tax-free money. And when you pull it out, as long as you use it for what you're supposed to use it for, medical purposes, then that money never gets taxed. You never have to pay tax on it. But you have to be very, very careful because, like I said, they're structured so many different ways that you have to read very carefully, because on a lot of them, by December 31st, any money that's in there that you haven't used yet, you lose it. And your account starts over at 0 on January 1st. So you have to be very careful about how much you put in there, and don't put more than you think you're going to need. Now, some of these health savings accounts even allow you to put money in for children, for diapers, and for baby food, and for formula. I had a friend who used to work right here at Geechee Tech, and she had 2 babies. They were like 11 months apart or something. And she had a health savings account that she put money in to buy diapers, formula, and baby food. And even things like, for the older one, even things like milk and cheese. It's kind of like the WIC program, but as you had to buy healthy stuff, okay, with the food, with the money. And that money never got taxed. So it's a really good way to decrease your taxes, but you have to watch it and be so careful with it that for me, I just don't even know if it's worth it. Yes. Health savings accounts would be for the taxpayer, the spouse, and any dependents that they have. Okay, and on page 14, it says at the top of the page, distributions are free of tax when used to pay for qualified medical expenses. Listen to the next sentence. For 2012, distributions which are not used to pay for medical expenses are subject to both income tax and a 20% penalty. 20% penalty.
So if it's still in there by the time the year's over, you have to...
Well, it depends on the health savings account and how it's structured. But if you do have an account that you lose what you don't use by December 31st, aren't you going to pull it out and use it? Yeah. But if you don't have a medical reason to use it, say you pull out $1,000 that you have in there so you won't lose it. Well, that $1,000 has not been taxed yet, so you have to include it in your gross income and pay tax on it, plus you have to pay a 20% penalty because you didn't spend it on medical things. So you lose a lot of it. So, it just depends on what you think your medical expenses are. And for each person, yeah, really, Danielle, that's the truth. So really it depends on what your situation is as to whether or not it would be good for you to even have a health savings account. Are there any questions on that? Okay, let's move on to moving expenses. Now, the government allows you to take an expense on your tax return for moving expenses. And I want to show you this on the overhead projector. Y'all, are moving expenses an itemized deduction?
It's on.
Are moving expenses an itemized deduction?
No, because it's somewhere, it's actually on the form. Right?
Itemized deductions come on what form?
Moving expenses are, they come off for the adjusted.
Itemized deductions are those deductions you can record on Schedule A.
Yeah.
Moving expenses are not recorded on Schedule A. They are not an itemized deduction. They are, however, look at this. You might need this for your tax return. On line 26, it says moving expenses, attach form 3903. And guess what? I know that you have to fill out a 3903 for your next tax return. So this might be something that you'll see on your tax return. So, moving expenses are not an itemized deduction. They are an adjustment for adjusted gross income. Okay? Just wanted to show you that.
What line was that again, Bob?
26. Sure. Now that we know our moving expenses are deductible, exactly which cost can we deduct? Well, not everything for sure. It used to be years ago that you could make a pre-move house hunting trip and deduct it. 22 years ago, my husband and I moved to Statesboro from Orangeburg, South Carolina. Orangeburg's a great place to be from, away from. I would never move back. My mom and daddy say, "Oh, I can't believe you don't like your hometown." I said, "Statesboro's my hometown now. I love Statesboro." But when we moved 22 years ago, we could deduct the cost of coming over in the weeks ahead of time to find a house. We could deduct that. But you can't deduct that anymore. That's an old thing. You may see that in some of your homework questions simply because for people who used to fill out taxes when that was allowed, they try to trip you up. Pre-move house hunting trips are not deductible. But here's what is deductible. Moving of your household goods. Y'all, if you rent a U-Haul to move your household goods, that U-Haul is deductible. If you pay a moving company $10,000 to come pack you up, load you up, store you for a month until you find a house, and then move you to that house, that whole $10,000 is deductible. That's the cost of getting your personal household goods to where you need them to be, to your new place. Okay? Now, so the cost of moving your household goods is deductible, no matter how you choose to make that move. Then, you not only have to move your household goods, you have to move yourself, don't you? Mm-hmm. On the day of the move, the mileage for every vehicle, now it's not 55.5 cents this time. For moving, it's reduced to 23 cents a mile. 23 cents a mile. And your mileage for husband's car, husband's truck, wife's car, 20-year-old child's car, 17-year-old son's truck, whatever. The cost to drive your motor home, the cost to pull your boat, whatever you have, you've got to move it from your old home to your new home. So the cost of moving yourself and your family is all deductible. So if you move 1,000 miles and you have 5 vehicles, you can take 5,000 miles times 23 cents a mile.
23.
23 cents. I'm glad you made it, Raven. I got your email, thank you. So, listen, if you move from California to New York City and you have to stop and spend 2 nights in a motel, both nights in the motel are deductible, fully. But don't eat anything because food is not deductible. No food is deductible on a move. Yes, ma'am.
So like from New York, California, or whatever, it's in far like that, your plane ticket would be deductible.
Yeah, if you don't have a vehicle to drive and you're moving via plane, absolutely. If you had your household goods shipped and you're taking
What if
you're taking a plane. Yeah,
People like driving to Baltimore.
vehicle. We said 23 cents a mile on a vehicle.
Well, no. I'm saying like if you moved your vehicle, you weren't in it, you were on the plane. What about your vehicle being?
Yeah, whoever moved your vehicle, the cost is deductible.
Okay.
How much ever it costs them.
All that.
All of that is deductible, but not food. Not food. Okay? Hopefully your neighbors will plan you a little welcome party when you get there and feed you.
Oh, somebody.
No, of course you're going to eat on your way, but it's just not deductible, okay? Now, what makes a move deductible? What makes a move deductible? Well, you have to move a certain distance, and you have to change jobs. Now listen, guys, just because you want to move from Savannah to Statesboro, just so, and you're still going to work at the same place, that move is not deductible. You have to change job locations. Now, do you have to change companies? No. No. Let's say I work for a company in Savannah. Okay, here's my job, and here's my home. Oops. There's my home. And let's say that this from home to my job is 40 miles. Okay? Then in order for me to deduct a move from this home to another home, the distance from my home to my new job, this is my new job, has got to be 50 miles more than from my home to my old job.
So that's be 90 miles?
So yes. So this has got to be 40 miles plus 50 miles. At least, in other words, if you're already driving 40 miles and you take a job at a place over here that's 45 miles, no, we're not going to pay you to move over here. You're already used to driving that far. Okay? But if you move a distance that would cause you to have to drive one way 50 miles more than you already drive right now to work every day, then you're allowed to deduct your moving expenses. So it's the distance you're driving now plus 50 at least.
From your original home.
From your old home.
Gotcha.
From your old home. Now, because this job, let's just say that this one is 100 miles, okay, 100 miles from home to job, because it's more than this, it's more than 90, it meets the qualifications. So, to move from my old home to my new home, which would be in this town, close to my new job, then I can deduct my moving expenses. Now, there's more to it than that. In order to change job locations, okay, you have to change job locations. You have to move more than 50 miles. And when you change jobs, you've got to stay on that job for at least 39 weeks out of the first year, out of the next 12 months. You've got to be there 39 out of the next 52 weeks. Okay, so you have to stay at that job. Hey, if you get, let's say this is the same company. Let's say this is Walmart. My old job was in Walmart. And they moved me to a different Walmart. And I moved, but I didn't like it. I stayed there 3 months, and I went back to the other Walmart. Now, you can't deduct your moving expenses at all because it wasn't a permanent move. You didn't make that move. Now, if you've already filled out your tax return and taken that move, are they going to check it? No. But if you get audited, you may have to pay some back. Okay, listen guys, I want you to go take a break. It's 10:30, and I want you to, when you come back, we're going to start talking about individual retirement accounts. And I just want to, once I get talking about that, I want to stay on that topic until I finish with it. Algebra. What about algebra? What's not clear? I love it.
What you just for that phone, your algebra?
Oh, no, not yet. If I do, it's probably gonna be sometime fall. If I do take it.
Yeah, if you decide and I mean, just if you pay the house, you just the house payment.
Oh, okay. Would you, are you in but on your way down 80, would you stop at the insurance company and we need to get a copy of insurance on the
You
car?
just didn't do that. And he ain't gonna have you if you don't have to.
Tell him it's my birthday, and so I've already just got off the phone with them, tell him to come and pick up, the insurance
Next
card.
session is West River crying last night. I just stopped. Okay.
And Brandon, when you pick me up,
One
bring
of the
that.
questions,
Yeah.
and I'm like, where did they get that number?
That, I'm gonna put it in 1, 2, 3 steps, okay? And to make that a lot easier.
And it was the thing with the example problem, and I thought I had read, I mean, I was,
Yeah, it says like 160.
when they were explaining, I'm like, where did they get these numbers?
And just write that down.
Do I just skip over that?
No, it's all in the boxes. It's in those boxes.
I appreciate the thank you, sir.
And it's very confusing.
Huh? Just log in there and tell them you're picking up your insurance card and share it with them. I just got off the phone with him, he said he's just gonna give you a copy of the paper or something. And I need to add in the mileage off the card, that's it. Thank you.
No, I've never used it, I haven't opened it, but if we were to put
Hello.